Welcome to the deep dive. Today we're taking a close look at Kirloskar Ferrous Industries Ltd, KFIL. They're a major Indian industrial player, and the recent financials, well, they tell a really interesting story about navigating today's market.
Absolutely. It's a fascinating company to track.
So what we've got in front of us are their unaudited results for the quarter ending June 30, 2025, both standalone and consolidated.
Right. Plus the press release and the auditor's limited review. Pretty comprehensive stuff.
Exactly. And our goal here isn't just to read out figures. We want to, cut through the noise, understand how they performed, sure, but really why and what strategic moves they're making.
So you walk away with the key insights without getting buried in the details.
Precisely. So let's kick off with the big headline number. KFIL's standalone net profit for Q1 FY26. It jumped an impressive 27% year on year.
Wow. Okay.
Yeah, and that's alongside an 8% increase in their standalone revenue. Just for context, when we say crores, that's 10 million Indian rupees. So these are significant numbers we're talking about.
That's a really strong start to their fiscal year. I mean, a 27% profit jump on solid revenue growth, that definitely makes you sit up and take notice. You immediately want to know what's driving that.
Absolutely. So let's unpack those core figures a bit. Standalone revenue from operations came in at 1,685.1 crores. That's an 8% increase from last year.
Okay.
And the net profit, the PAT, as we said, was 95.8 crores, up 27% from 75.6 crores last year. Big jump.
And that flows through to the earnings per share, too.
It does. Basic EPS went from 4.60 to 5.82, so a nice lift there as well.
And what's interesting is looking at the consolidated side, so including their subsidiaries, that picture looks just as good, maybe even a bit stronger in some ways.
How so?
Well, consolidated revenue from operations hit Infire's 698.1 crores. That's a 9% increase year on year. Slightly higher growth than standalone,
Okay.
but the consolidated net profit, 95.1 crores, that represents a 36% increase compared to Q1 last year.
36%. Wow.
Yeah. So that suggests the subsidiaries are contributing positively, maybe even punching above their weight a little this quarter. It points to, healthy performance across the whole group, not just the core company.
Right. Integrated growth. So the big question then is, what's powering this? What are the underlying drivers here?
Well, the managing director, R.V. Gumaste, gave some context in the press release. He talked about a, quote, steady recovery in demand from the tractor sector, iron and steel sector.
Okay, key sectors for them.
Exactly. And he also mentioned this was, quote, supported by improved sentiment and easing supply constraints.
That easing of supply constraints feels important. We've heard so much about bottlenecks over the last couple of years.
It really is. It suggests things are normalizing. Better availability of raw materials, smoother logistics, that directly impacts a heavy industry player like KFIL. It means, a more predictable environment to operate in.
And the demand recovery in tractors and steel, that points to broader economic health, wouldn't you say?
Definitely. Those are bellwether sectors for industrial and agricultural activity in India. So seeing recovery there is a positive signal for the wider economy and obviously crucial for KFIL's customers.
Okay, so demand is picking up, supply chains are easing, but what are they doing strategically? Are they just riding the wave or actively shaping their future?
Oh, they're definitely making moves. Seems like they're thinking longer term. First off, they've proposed merging two wholly owned subsidiaries, Oliver Engineering and Adika Energy Solutions, right into the main KFIL entity.
Okay, what's the thinking there? Just tidying up.
Pretty much. Simplifies the corporate structure, makes things more efficient, probably cuts down on some overheads, and helps with synergy, easier resource allocation, faster decisions, standard corporate housekeeping, but important.
Makes sense. Anything else on the strategic front?
Yes, and this one's pretty significant. They were declared the preferred bidder for the Jambunatha iron ore mine auction in Karnataka.
Iron ore. That's fundamental for them, right?
Absolutely critical. For a ferrous industries company, securing your key raw material is huge. This move is explicitly about strengthening their raw material security. In today's volatile commodity world, it's like gold dust, or iron dust, I suppose.
Yeah, it's a major de-risking move. Controls costs, ensures supply.
Exactly. And tying into that, these mergers also expand their product portfolio. They'll now have ISMT steel and seamless tubes under the KFIL umbrella more directly.
Tell me more about ISMT.
Well, ISMT is actually a pioneer in seamless tube manufacturing in India. They're known for high-quality stuff, bearing tubes, boiler tubes, automotive piping, alloy steel. So this isn't just adding a product line, it's significantly broadening KFIL's market reach into some pretty specialized areas.
To diversification and moving up the value chain, potentially.
Could be. And they're backing this up with investment in their core operations, too. They're expanding capacity in pig iron and casting.
Okay, more volume.
Yes, but also smarter volume. They're using things like 3D printing for product development, which speeds things up considerably. And they've added a coke oven facility that includes waste heat recovery power generation.
Ah, so efficiency and a nod to sustainability there too.
Precisely. It's about producing more, but also producing better and more efficiently, which ties nicely into their profitability metrics.
Right, let's look at those margins. You mentioned the profit jump, but how does the operational efficiency look?
It's looking better. Standalone EBITDA margin improved to 12.7% this quarter, up from 12.1% last year.
Okay, decent step up.
And consolidated EBITDA margin also rose, hitting 12.8% compared to 12.0% last year. So they're squeezing more operating profit out of every rupee of sales.
And does that translate to the bottom line margin as well?
It does. Standalone net profit margin went from 4.86% to 5.68%. And consolidated net profit margin increased from 4.49% to 5.60%. So yes, they're keeping more of that revenue as actual profit. That's a healthy trend.
Definitely. So good profitability. What about their balance sheet? How's their financial health looking? Debt levels, for instance.
Looking stronger there, too, actually. Their debt-to-equity ratio has improved. Both standalone and consolidated are down around 0.35, 0.36 now, compared to 0.40 last year.
So less reliance on debt relative to their equity. That's generally seen as positive.
It is. It indicates a stronger, less leveraged balance sheet. And crucially, their ability to service that debt has improved significantly.
How do we see that?
Through ratios like the debt service coverage ratio, or DSCR, it basically measures if their cash flow is enough to cover their debt payments. That ratio improved quite a bit year over year, both standalone and consolidated.
Okay.
Same story for the interest service coverage ratio. Their ability to cover interest expenses from earnings also saw healthy improvements. It just shows stronger cash generation relative to their obligations.
And liquidity, short-term health.
Looks fine. The current ratio is hovering around 1.10 for both standalone and consolidated. Generally, anything above 1 indicates they can cover their short-term liabilities. So yeah, overall financial health seems pretty robust.
Good to hear. Now, sometimes the headline numbers hide variations underneath. Let's break it down by segment. Where did the growth really come from?
Good question. The tube segment was a clear standout. Revenue there jumped quite substantially, reached about 571 crores compared to 454 crores last year.
Big increase.
Yeah, and the profit from that segment, the segment result before tax and interest, also rose significantly. So tubes were definitely a growth engine this quarter.
What about casting and steel? They're big parts of the business too.
They are, and here's where it gets interesting. The casting segment actually saw a slight dip in revenue compared to last year, down to about another euro crores from roughly 1,029 crores.
Oh, okay. So less revenue.
Yes, and this is key, its profitability, the segment result, actually improved. It went up to over 100 crores from about 88 crores.
How does that work? Less sales, more profit.
It suggests maybe a better product mix, selling higher margin castings. Or perhaps better cost control, improved efficiency within that segment. Same kind of story in steel, actually. Revenue was down a bit compared to last year, but the segment result ticked up slightly.
So even where the top line wasn't growing or even shrank slightly, they managed to improve profitability. That points to some pretty effective operational management.
Exactly. It's not just about chasing revenue, it's about profitable revenue and efficiency gains.
Right. Before we wrap up, any other notable points? Governance, financing, anything like that?
Just a few quick things. The results were, of course, reviewed by the audit committee and approved by the board on August 4th. Standard procedure. And the auditors did a limited review and gave an unmodified conclusion, basically, a clean bill of health for the figures presented.
Good. Any financing activity?
Yes, they raised 400 crores by issuing commercial papers during the quarter. That's typically short-term debt for working capital needs. Most of it was still outstanding at the end of June, and they also allotted a small number of shares, about 6,840, under their employee stock option schemes. So a minor increase in equity capital there.
Got it. And there was one small exceptional item you mentioned on the consolidated side.
Yeah, a gain of about 2.5 crore. It related to the decision to liquidate a subsidiary in Luxembourg, ISMT Enterprises SA. Involves some accounting reclassifications. It's a one-off, but it ties back to that theme of simplifying their corporate structure.
Right. Tidying up loose ends. Okay, so let's pull this all together. What's the big picture takeaway for Kirloskar Ferrous Industries?
Well, you got a company posting really quite strong results, especially on the profit front, driven partly by recovering demand in key sectors, yes, but clearly also by their own strategic actions.
Like the mergers, securing the iron ore mine.
Exactly. And that focus on operational efficiency that we saw in the segment results and the margin improvements. Plus, they're maintaining a healthier balance sheet. It paints a picture of a company that's not just performing well now, but actively positioning itself for sustained future growth.
So for you listening, this deep dive really offers a concrete example of how a major industrial company navigates both market cycles and implements long-term strategy. It's about reacting, but also proactively shaping your environment.
Yeah, optimizing operations, securing resources, simplifying structure, all while dealing with the ups and downs of demand.
Absolutely. And it makes you think, doesn't it? When you see KFIL blending traditional heavy industry iron, steel, castings with newer approaches like 3D printing and that strategic focus on raw material security, what does that signal about industrial development in India more broadly?
That's a great question. How might moves like these shape the competitive landscape? Are other players taking similar steps?
It's definitely something worth pondering as you look at other companies in this space trying to navigate, a pretty complex global economy right now.